My name is Brad Allen, and I'd like to echo Les's comments and thank everyone for coming out today. It's great to see a good turnout here. And Jamie and I are going to spend the next 30 minutes or so talking about the current GST issues for holding companies. And we've been dealing with a lot of issues with a number of our clients with respect to input tax credits or GST refunds. So we'll start talking about what's happening currently for holding companies to claim input tax credits. We'll discuss the general rules for claiming input tax credits that's available for all companies. We'll discuss the specific rules for claiming input tax credits for holding companies. We'll review CRA's current administrative practice, policies, and audit programs relating to holding companies. We'll briefly discuss the tax dispute process, and then finally we'll provide our closing comments and open the floor for questions. So if we look at what's happening now with the number of CRA audits for GST returns relating to holding companies, it's important to first look at the legislation, and it's remained unchanged since 1997. And even before that, it hasn't really been substantially changed from the implementation of GST. So in our typical client content, we've got a public company that has its management here in Vancouver. It's listed on the TSX. It has a foreign subsidiary, or maybe a couple subsidiaries, one in Mexico and one in the United States. It's filing GST returns. It doesn't have any revenue. It's paying expenses for overhead and claiming input tax credits. It's filing returns with the government, and it's receiving refunds. And this was happening consistently, and let's say it's been the last 10 years. And especially now with the current economy and companies are having challenges raising money, a lot of companies are using those GST refunds as part of financing, and in some cases using those money to keep the lights on. So it's an important issue, I think is very current. And what is that, I think with Revenue Canada, is they have a very narrow view of what is applicable and what is allowed for a holding company to claim input tax credits. And as tax practitioners, of course, we don't always agree with CRA, and we look at it much broader and look at that a direct or indirect use or expenditures for overhead costs should be allowable. So the CRA, what they've been doing is basically a two-pronged process. Is they've been increasing compliance with the number and frequency of these input tax credit or GST audits, and they're trying to have their narrow interpretation of the GST legislation followed by companies. And also, I think more importantly, they're using it to increase revenues. And I think it's not unexpected that you've got the government is looking for new revenue sources, and unfortunately, public companies have been targeted, along with capital pool companies, with their GST refund claims. So then we'd look at the courts and say, okay, what are the courts saying? Are they in agreement with CRA's narrow interpretation? And it's a kind of a good news, bad news, is that there are cases where the courts have held that they don't agree with the narrow approach by CRA and that should be much broader. But unfortunately, there's not many cases that have gone to the courts, partly because we've had this history absent if we go back 2012 prior, where companies were generally getting their refund checks, and there could be a GST audit in between, but generally companies were filing the returns, weren't reporting any revenue, but they're still getting their input tax credits back. So not a lot of dollar amounts were going to the court level, and also not many decisions were made in tax court because the dollars weren't significant. So now I'll turn it over to Jamie, and he's going to review the general rules for claiming input tax credits.
Thanks, Brad. I thought I'd just go over the general rules for ITC claims, just to kind of give you guys a little bit of primer before I get into the meat of the presentation. So as many of you are aware, GST registrants are eligible to claim input tax credits to recover the GST paid on their expenditures. This is to the extent that they are engaged in commercial activities. So then the question then becomes, well, what does commercial activity mean? And in a corporation, for a corporation, it simply means that they're carrying on a business. However, it does not include an exempt transaction, or what we commonly refer to as an exempt supply. So a common example of an exempt supply or an exempt transaction would be the supply of financial services. So, for example, if a holding company were to, the only activity that the holding company had was holding shares of a subsidiary, buying and selling shares, loaning funds, that would be considered a financial service, and no ITCs could be claimed with respect to that activity. So these are the general rules relating to ITC claims. So now we look at the ITC claims in the context of a holding company. So normally the common structures we see, as Brad had indicated, we have a Canadian public company that's doing business worldwide. A lot of times they'll have a foreign subsidiary. And the real purpose of this corporate structure is to have the Canadian holding company raising capital in the markets in Canada, and then either buying the shares of the foreign subsidiary or loaning the money down to the foreign subsidiary for use in the foreign subs operations. So if you look at just the general rules that we went over, and absent any other special rules relating to holding companies, you'd see that the Canadian parent company is actually not engaged in commercial activities. It's simply holding shares of the foreign subsidiary. It might loan money down to the subsidiary, but it's not doing any other activity. So in that particular case, the holding company, just using the general ITC rules, would not be eligible to claim the input tax credits. So with that being said, there are special rules that Brad indicated relating to ITC claims for holding companies that was introduced years ago. So it's a special relieving provision. So in order for Canadian holding companies to be eligible to claim ITCs, two main criteria or two main tests need to be met. Number one, the expenditures of the holding company must reasonably be in relation to the shares or debt of its wholly owned subsidiary. And number two, all or substantially all of the subsidiary's assets must be used in commercial activities. So if you look at these rules, the rule is basically designed or intended to pierce through the holding company and look down at what the foreign subsidiary is doing. And if the foreign subsidiary, for example, were able to claim ITCs as if it were a Canadian company, then the ITCs would be allowed. So looking at the two tests, you'll see that the second test is usually quite easy to be met. The foreign subsidiary is usually, for example, engaged in mineral or oil and gas exploration, so that would be considered a business carried on by a corporation and would meet the test of commercial activity. And really the issue then becomes the first test and that term in relation to. So again, the holding company's expenditures must be in relation to the foreign subsidiary. Absent that test being met, the ITCs would not be claimable by the holding company. So with that being said, the CRA does have some guidelines on what they consider to be eligible ITCs for holding companies. It's not extensive, obviously, as you can imagine. Some of the examples are accounting and legal services on the acquisition of additional shares of the subsidiary, legal fees incurred on the sale of the subsidiary shares, and my favorite here is the administrative overhead provided the parent corporation can demonstrate that the costs meet the requirements of the provision. So if you look at just that third example regarding the administrative overhead, you can see the CRA has worded it quite broadly. They haven't really given any guidance in terms of what type of administrative overhead would be allowable. But the takeaway from that is in certain circumstances, the CRA will allow administrative overhead to be claimed as input tax credits. So in this next slide, what we thought we'd do is give you kind of an example of what we see commonly in terms of claiming ITCs by holding companies. So again, the common structure is to have a Canadian parent company with a foreign subsidiary. The foreign subsidiary is engaged in, for example, exploration activities, and the parent company is incurring all of these Canadian-based expenditures that relate to that foreign subsidiary. So what we've been seeing over the years is the parent company was claiming ITCs, all of the ITCs on their expenditures, on the basis that all of those expenditures related to the operating company. So it was basically making the ITC claims directly to the CRA. And then previously, I mean, as Brad indicated again, over the years, the CRA was allowing all of these ITC claims to go through, and then over the last 18 months, the CRA has actually been denying a lot of these ITC claims in full. So, as you can imagine, anytime the taxpayers are obviously taking a broad interpretation of the legislation, the CRA is taking a narrow interpretation of the provision. It really comes down to what the courts say. So one of the prominent court cases is Stantec Inc. It's a 2008 court case. Just to give you a little bit of primer of the Stantec Inc. court case, it was really no different than this structure here. Stantec Inc. was a Canadian holding company, and it basically listed itself on the stock exchange to raise capital and buy the shares of a subsidiary. So there were really two transactions here at play. One was the raising of capital on the public markets, and then secondly, the acquisition of the subsidiary shares. So in this particular case, Stantec Inc., the holding company, took the position that the raising of capital, those expenditures, for example, the listing fees, which amounted to about $59,000 in ITCs, were in relation to acquiring the subsidiary shares. And as you can imagine, the CRA said, no, we don't agree with that position. The raising of capital is one step removed from the acquiring of the subsidiary shares, and we're going to deny that ITC claim. So the CRA contended that there needed to be a direct correlation between the expenditure and acquiring the subsidiary shares. Luckily, in the taxpayer's case, the court actually sided with the taxpayer and said, you know what, if you read the provision, there's nothing in the provision that says there needs to be a direct connection between the expenditure and acquiring the shares. It simply needs to be in relation to that term that's in the provision, and that term in relation to is supposed to be interpreted in the broadest sense possible. So they simply said there needs to be a nexus between the listing fee and the subsidiary shares. So now Brad is going to now talk about the CRA's review of ITC claims in light of the Stantec court case.
Thanks, Jamie. So what we've been encountering with a lot of our clients in the last 18 months is a dramatic increase in CRA audits relating to input tax credit claims for our holding company clients. And we've made some phone calls and talked to some other people in town in Vancouver, other tax professionals, and also in Toronto, and it's happening as well. So it's not just an isolated program here in Vancouver. And as Jamie mentioned, it really is focused on in relation to its subsidiary. And CRA's interpretation that it's a direct link, where practitioners in the courts have our opinion is that it's more indirect, and you can have a two-step transaction where you should be eligible for this input tax credit. So for one example, the CRA position is that activities relating to the raising of your own capital, and then loaning that money down to your foreign subsidiary, all the fees incurred in that, if you're paying GST on those fees, you would not be eligible to claim an input tax credit in CRA's view. Now, the courts have taken a broader interpretation, as I mentioned. Unfortunately, the Stantec case was heard under the Tax Court of Canada's informal procedure, and I'll mention that in a moment. But what happens is, under that procedure, informal procedure, CRA does not have to respect that decision. So it's unfortunate, and I'll touch on that in a moment. So what happens when the audit process starts? So generally, company is going to receive an audit letter. In that letter, they'll ask for a description of the business, They'll ask for some accounting information, a general ledger, some invoices. And the big, I think, takeaway for holding companies is there's a requirement to do an allocation of the expenditures on a commercial and non-commercial basis. So as I mentioned, if someone was paying fees relating to the financing of raising money, CRA's view is that's a non-commercial activity. And CRA Audit is taking this very hard line with their auditors, and even if a client is providing this information, what we've encountered lately is that they're just ignoring it and they are denying all the input tax credits. So then the next step is to go to appeals if a company doesn't agree with the decision made by CRA Audit. There's a 90-day deadline to file a notice of objection to effectively appeal that decision. And what we're finding is that appeals is overloaded, and it takes quite a bit of time to have even an appeals officer assigned. So this process, when it's in appeals, could go from 6 months to a year or longer. So there's some uncertainty, and unfortunately it is not a very long process. So if a company is not successful at appeals and that decision is not overturned, there is an opportunity to appeal to the Tax Court of Canada. And again, we have this 90-day time limit to file an appeal document with the tax court. And right now, most of our clients are involved at the appeal stage. So we've gone through the first round where the auditors are effectively rubber stamping a denial of input tax credits for holding companies. And now Jamie and I are spending a lot of time dealing with the appeals division in trying to have them come to the right decision. And unfortunately, we're not getting any really headway there. And none of our clients have had decisions that have been made by appeals, but we've had some informal discussions and comments, and it appears at the time, for the time right now, that CRA appeals is basically going to rubber stamp and basically deny the input tax credit claim that the company is making. So when we go to tax court, there's two options. There can be an informal procedure or a general procedure. And the informal procedure is when the amounts at issue are $50,000 or less. And unfortunately, this was a Stantec case, so they went to informal procedure, which means the rules are a little bit less formal, they're lax, and it's easier on companies to comply. But unfortunately, the CRA does not have to respect a decision that's made in the informal process. So we don't have any precedent when we have these decisions made that are in the taxpayer's favor dealing with holding company input tax credits for holding companies. So to summarize, I think what we have is we don't see the environment changing for the short term, and that could be 6 months to 2 years, where CRA Audit is still going to be targeting public companies that have a holding company structure, and that they will be still coming in to deny input tax credits, and that we likely won't be making any headway with CRA appeals as well. And what we're hoping is that there's going to be some clients of ours, or there's going to be some other companies that have amounts at issue that are significant, that are $200,000, $300,000 of denied input tax credits, and that it's worthwhile for them to go to court, and then hopefully we'll get a reasonable decision that's similar to the Stantec case, and which hopefully will give everyone some certainty or more comfort when these returns are being filed and all these refund claims are being made, that companies are going to be getting that money.